Initially, they assured us that the housing market was stable and that the sharp increase in prices was a positive indicator. Then economists were forced to admit we were in the biggest housing bubble ever. The Dallas Fed is predicting a 20% correction in housing prices. Even though home prices have increased on average by 47% over the past couple of years, it is safe to say that a 20% drop won't correct markets where prices skyrocketed over 70% like in Austin, Texas or Boise, Idaho. It would take a whole lot more to bring the overvalued housing market back to normalcy. We have a lot to cover in this video. Before we do, we kindly ask you to support our growing channel by giving us a thumbs up. And don't forget to subscribe. It will be your good deed for today. According to estimates, almost 60% of the US housing market is significantly overvalued currently. This is a disaster for homeowners who are already dealing with rising mortgage rates that are twice as high as they were in 2021 and declining property values that have already wiped out trillions in home equity this year. According to Redfin, home prices will experience their biggest annual decline this year since 2008. No matter what the experts say, all signs point to additional future instability. US homeowners are experiencing an abrupt decline in their home equity due to skyrocketing mortgage rates that have reduced purchasing power and driven down home values. Real estate analysts note that the massive loss in equity that nobody thought possible is already upon us, and losses will only get bigger from this point on. Recent home purchasers are concerned about the deepening price slump because they fear that decreasing prices will keep them in their pricey mortgages and have uncomfortable implications like tighter finances and postponed retirement. According to statistics from September, released by mortgage services company Black Knight, US homeowners with mortgages has collectively lost $1.5 trillion in equity since May. Since then, the number of underwater mortgages, where someone owes more on a loan than it is worth, has increased. Since their debt exceeds the value of their property, some 450,000 homeowners are already underwater on their mortgages. Since the Federal Reserve started slowing the economy to contain inflation growth, the wealth of American households has vanished, collapsing by more than $6.8 trillion since January. The combined net worth of US households fell to $143.3 trillion last quarter from $145 trillion the quarter before, and nationwide double-digit declines in property values haven't even begun yet. From June to November, the value of the typical home decreased by over $40,000. According to the most recent report by the National Association of Realtors, sales of existing homes, including single-family homes and townhomes, fell primarily due to weaker demand because higher mortgage rates are making homes less affordable by increasing the average monthly payment by over $1,400, a staggering amount for the average family already in debt. The report highlights that all regions of the US saw month-over-month and year-over-year declines. In addition to seeing the value of their homes going down like the Titanic, Americans have faced plummeting stock values and have taken on loads of debt. Condominiums and co-ops were down by almost 30% last month from a year ago and down 6.5% from October, falling for the 10th consecutive month to an annual rate of 4.4 million, down from nearly 6.5 million in January. Inflation has caused many cash-strapped families to take on massive credit card debt. The statistics indicate that homeowners, particularly those who bought their homes this year, are at major financial risk. In fact, according to Black Knight data, about 10% of American households that bought a home with a mortgage in 2022 are already underwater, and at least 40% have less than 10% equity. As home price decreases accelerates in 2023, Black Knight Vice President of Research Andy Walton predicts that more individuals will go into debt shortly. A few weeks ago, the Dallas Fed issued a paper cautioning the housing market may see a 20% decline before returning to its fundamentals, which prompted Black Knight to simulate some projections. An estimated 4.5 million homeowners, or 7% of all homeowners, would then be underwater, increasing their risk of foreclosure. In total, mortgage holders would lose $6.2 trillion in equity, and that's the best-case scenario given that since 2020 prices have increased by 47% and wages have decreased by 3.7%. This decline should balance out the existing housing market's distortions and restore house affordability. However, Boston University economist Adam Gurin explains that as home prices decline, consumers cut back on their spending primarily because they have less equity available to them to use for cash-out refinancing and home equity lines of credit. They become cash poor. According to Gurin, bigger drops of around 50% may have a disastrous impact on the overall economy, pushing consumers to cut spending by about 10%. In some markets, such as Los Angeles and San Francisco, home prices have already fallen 10% from their peak, which is half of the rate predicted by the Fed. However, while lower home prices may encourage more first-time buyers to enter the market, it may also make it more difficult for current homeowners to sell or refinance their homes because borrowers must pay off their old mortgage, which most can't do if their equity falls into the negative. First-time homebuyers are especially battling with high costs because they made up fewer than 25% of deals last month. Up to this point, higher rates and lower prices haven't produced any of the benefits policymakers believed they would. According to Lawrence Gunn, the chief economist for the National Association of Realtors, sales in November were really at their lowest points since May 2020, when the real estate market was at a halt when lockdown started. Beyond that, sales this month were the poorest of all time. The impact is greater in expensive areas of the country and in markets that saw significant home price gains in recent years, Jan added. The repercussions are also impacting sellers at the moment, as they're either dropping asking prices at a faster pace than at any point in the past few years, or removing their properties from the market altogether. Since December 2011, more potential home buyers were squeezed out of qualifying for a mortgage in November as Mortgage Rate Market Index, a closely watched industry metric that gauges the outlooks, climbed higher. At this point, we are already in a housing recession, but the central bank appears to be threatening to turn it into a housing depression. The housing for home sales declined to 33 on a 100-point scale, its lowest level in a decade. Essentially, housing bubble bursting is making conditions worse for everyone: owners, buyers, sellers, and even real estate agents. By mid-2023, the typical home is anticipated to have lost another $25,000 in value. These price drops will start in the first quarter, when owners seal transactions on properties that were put under contract at the end of the current year, marking the biggest decline since the previous bubble burst. According to Taylor Moth, the deputy chief economist, property prices have already started to decline every month in numerous cities. According to Chris Rapke, chief economist of FWD Barnes, when the overall economy grows, everything else follows. If it is declining, everything else will also become out of place. The national savings rate is at an all-time low, just as unemployment rates have reached the highest pre-pandemic level, rising to 1.7 million at the end of November. Mr. Rapke notes tighter borrowing conditions are also affecting businesses, and they've been cutting jobs by the thousands. The economy is deteriorating at an alarming rate, and millions of US consumers are already living on the verge of a financial disaster right now. Without a job, millions of households worldwide will be unable to pay their mortgages, and foreclosure rates, which have already increased by 64%, will continue to climb according to Data Solutions. This is similar to how politicians and policymakers initially denied that inflation was a problem, and that rising prices would not be detrimental to the economy. But Americans aren't naive. They already recognize that the situation is deteriorating, and a recent survey by Landing Trees revealed their growing mistrust. According to the survey, 41% of Americans believe that the housing market will experience a significant crash within the next 12 months. In contrast, only 25% of respondents said they believe that the sector would avoid a crash, while 35% said they were unsure. About one-third of respondents cited inflation as the key factor leading to a forecasted crisis, while 24% mentioned high interest rates. In many respects, what is happening now resembles the world shortly before things started to go south in 2008. Claims from central bankers and the federal government that we are better prepared this time around, and that a crisis wouldn't be as catastrophic as it was at that time should be taken with a grain of salt. We could afford the cost of living in 2008 because the economy wasn't headed for a recession. Inflation wasn't 7.4%. Businesses weren't on the verge of bankruptcy, and thousands of workers weren't being laid off every week. However, this time things aren't much better, and despite knowing it, they're still expecting the mess to clear up on its own and disappear, as if nothing ever happened. Although they may not like to acknowledge it, there were warnings that this would be the biggest financial super bubble in all history. In 2023, we may all suffer the effects of the bubble's bursting, and millions of families will be ruined financially. Once again, a small guy can't catch a break.